I think the market's probably right that they're probably going to do 75 basis points. And I think the key thing the market's going to be watching for is what is the language around the eventual pace of tightening, right? So they've been doing these 75 basis point hikes, and I think the market is going to be looking at, are they hinting at a 50 basis point move, either the next meeting or the meeting thereafter? And so that kind of how hawkish or dovish Powell sounds, I think is really going to be the key question the market's focusing on. I don't have a strong answer between those two. So we've had this really sharp move up in the dollar, and some of those factors are still there, but a lot of things happen in macro around the margin. They happen in rate of change terms, and so I think what we're getting close to is that the Fed is kind of hitting peak hawkishness in rate of change terms, meaning the speed with which they're increasing rates, not the highest absolute level that they're going to get to before this is done. In addition, there's different components. There's the rate component, but then there's also basically the quantity component. What's happening with QE versus QT? What's happening with, say, SLR adjustments, which are basically regulations that affect how much treasuries banks can buy, for example. Or what's happening, outside of the Fed, what's happening with Treasury market and the Treasury general account, and potentially doing buybacks of treasuries to try to address some of the liquidity issues. And so I think we can segment things into a couple different buckets. And I think that in rate of change terms, they might be getting, at that kind of peak level. And so I think we have to start watching the dollar to see if that keeps screaming high or if that starts to get a little heavy. In this environment, because, most of the dollar index is weighted by the euro, and that's obviously facing energy crises, which have a couple different directions that can go in over the next couple years, as well as you have the yen, and they're doing formal yield curve control at a very low level, which is kind of like purposely devaluing their currency. So I generally am looking at things more of a currency by currency basis rather than that big bucket analysis. So I think that the bucket analysis is still something useful to look at for sentiment and overbought and kind of rate of change terms. But I think that where things will matter is on the margins. What's happening with, say, the dollar versus Brazil's currency, or the dollar versus India's currency, or the dollar versus China's currency, specific currencies. And so I think that in general, the ones with less debt and a less acute energy situation are better positioned here going forward. But I think the speed of the dollar index move we've seen so far is probably behind us. Well, if they have to do that, yes. I think eventually. The question is, how long can they push it? So the problem right now, if you look around the world, kind of the end game for this type of scenario, like at the end, what Ray Dalio would call a long-term debt cycle, where you have very, very high sovereign debt level, and then you eventually run into high inflation, usually due to a commodity bull market, just from underinvestment in capex. Plus, these things feed on themselves, so inflation and populism can lead to war, and that's more inflationary and drives more populism, and so these things become vicious cycles. We also have some degree of deglobalization happening, or at least globalization slowing down. It's not kind of jobs not pouring out to, say, China, for example, the way they were. Now you have that more of that geopolitical distancing happening, as well as, of course, the cheap Russian gas going to Europe is somewhat of a thing on the past. So we've had these elements that kind of shift the prior playbook, and in this type of scenario, you have to go back to kind of the 1940s to find a similar environment, which was sovereign countries, major developed countries with very, very high sovereign debt levels, and then they run into inflation. And the question is, how do they handle that? And normally the way they handle that is by printing despite the fact that inflation's high. So for example, if you look at Japan, they're doing yield curve control, which means that they're willing to print new money to buy bonds to hold their yield down, even though inflation's currently above their target. It's not as bad as some parts of the world, but it's above their target, and they're still printing money into it. You can also look at Europe, where they're doing spread control. They have Italy with 150% debt to GDP, and not a lot of demand for their bonds at these rates. And if they get to rates that are actually kind of make sense, that kind of causes a fiscal spiral for the country. So you have Europe, European Central Bank selling German bonds, buying Italian bonds to try to manage those spreads. That's another version of essentially printing into high inflation. it's just less extreme than what Japan's doing. Then you had the UK, where they had 10% inflation, and they had to do a multi-week period of unlimited QE when they were planning on doing QT to address the fact that most of the large pools of capital had to suddenly sell a lot of bonds due to leverage and other things like that. And the United States is better off than some of those, but we are seeing a lot of dysfunction in the treasury market. And part of the reason is when the dollar gets very strong, the foreign sector generally stops buying treasuries in aggregate. And it's because the whole point, the main reason why, say, foreign central banks hold treasuries is so they can sell them if they need to defend their currency at some point in the future. And so, it's kind of like a squirrel living off of the nuts that it collected all through the summer and the autumn. In the winter, it has to eat them. And it's kind of like that now. Now that you have this really strong dollar environment, those treasuries and all these different foreign pools of capital generally represent stored up acorns, nuts that they can sell if they want to backstop their currency. So, for example, Japan is selling, some of its foreign exchange reserves in order to slow the descent of the yen. We've also seen China reducing its treasury holdings. And so we kind of have an issue where the Fed's not buying treasuries, the foreign sector's not buying treasuries, U.S. banks, due to SLR regulations, are not really buying treasuries. And so, a lot of that has to come down to the domestic money manager or the retiree or the pension or the insurance company. And those are not as big balance sheets as those sellers. So I think eventually they're going to get to a point where they have to do some sort of liquidity program, and that could be while inflation is still hot, or maybe it's a second inflationary cycle. I don't think these things will be linear, but I think that generally the end game of a very, very indebted sovereign country is that they have to do often basically QE type of activities even when inflation's above target, just to support the bond market. So 2023, I think it's gonna be challenging to get through 2023 without having to do some liquidity provision, unless the dollar tops, right? Because this is kind of an if-or situation. So if the dollar keeps screaming higher, then that response probably has to come earlier, because then the foreign sector is probably going to keep trimming their holdings, and the economy is going to keep slowing down, and so that whatever that date is, it pulls it forward. On the other hand, if, say, they hint toward, okay, 75 basis points, and then we're going to slow it down to 50, and then we're going to be data dependent, they kind of, not a pivot yet, but more like a dovish language pivot. If they start to kind of do that, if you start to get a local top in the dollar index, if Europe continues to have a very warm winter, and therefore get some of its energy crises under control, maybe the euro stabilizes to some degree. If you get that sort of dollar, at least local top, that pushes back the date where the Treasury or the Fed might have to do some sort of intervention in the Treasury market, because that allows foreign buyers to either stop selling or potentially come back and buy around the margins. So I think that it's those two variables kind of together that you have to watch. But overall, I think that it's going to be challenging to stick to their full QT plan, going all through next year with say deficits where they are and with foreign buying currently where it is. Something would have to change.